every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning. It's Wednesday, the 4th of September, and a warm welcome to Money Talk. This is Peter Lewis with an update on the day's business and finance news. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, South Korea's inflation for August eased to 2% from 2.6%, its lowest level on a year-on-year basis since March 2021, and in line with expectations. On a month-on-month basis, the CPI rose 0.4%, slightly higher than the 0.3% expected. The latest figure marks the fifth consecutive month that price growth has remained below 3%, supporting the view that the Bank of Korea may start cutting interest rates soon. Trade tensions between China and Canada were ratcheted higher on Tuesday. China plans to start an anti-dumping investigation into canola imports from Canada, the Commerce Ministry said. And that's a retaliatory move after Ottawa moved to impose a 100% tariff on imports of Chinese electric vehicles and 25% tariffs on imported steel and aluminium. Canada is the world's top exporter of canola, which is used in food and biofuel. China is the world's biggest oilseed buyer. Two readings of US manufacturing production showed signs of weakness in August. S&P Global's survey showed a decline from July to August, while the Institute for Supply Management was under the level anticipated by economists polled by Dow Jones. The ISM Manufacturing Index came in at 47.2 for the month, up 0.4 percentage points from the July reading, but below the Dow Jones consensus forecast of 47.9, and factory activity contracted for a fifth month. All of the major stock indices in Asia, Europe and the US were lower on Monday. The sell-off in the US and Europe gathered pace after the ISM published its monthly gauge of US manufacturing activity, which was weaker than economists had expected. The IMS release was being particularly closely watched by investors, as a much weaker than expected survey last month was one of the sparks that helped start the global sell-off. And September has been the worst month on average for the S&P 500 over the past 10 years. The S&P 500 has lost more than 2% in an average September over the last decade. Coming up are Enzio von Pfeil, capital preservation specialist at Financial Shield, and Simon Kavanagh, partner at BDA Partners. With a view from Japan is John Beirne, principal economist at the Asian Development Bank. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. US stocks tumbled Tuesday after traders returned from the long weekend Labor Day holiday, as technology names struggled and new economic data rekindled fears about the health of the economy. This action comes ahead of the first major economic release of the month on Friday, when the US government releases the August jobs report. The major indices notched their worst day since the August the 5th sell-off, when stocks sold off following a weak July jobs report that stoked recession concerns. The S&P 500 slid 2.1%, closing at 5,529. The Dow fell 626 points, or 1.5%, to end at 40,937. The Nasdaq Composite dropped 3.3% and settled at 17,136. Semiconductor stocks were sharply lower. The Philadelphia Semiconductor Index fell 7.8% on Tuesday, its worst one-day loss since the onset of the COVID-19 pandemic. Nvidia dropped 9.5% in its biggest daily fall since April, and it lost $279 billion in market capitalization. That's a record one-day fall for any US company. Intel plunged 8.5%, Micron lost 8%, and AMD fell 7.8%. Treasury notes were bid across the curve in a risk-off session for markets. The yield on the benchmark 10-year Treasury fell 6 basis points to 3.84%, while the policy-sensitive 2-year yield fell 5 basis points to 3.87%. The US dollar index steadied 0.1% higher on Tuesday. The Japanese yen was by far the best performer among the G10 peers, with the US dollar yen slipping 0.9% to 145.45 yen per dollar. Other Asian currencies were weaker. The Aussie dollar finished near the session lows of 0.6708, ahead of Australian Q2 GDP and PMI data due later today. In Shanghai, the yuan was 0.1% weaker at 7.1209 renminbi per dollar. And gold fell 0.2% to $2,492 an ounce. Oil prices fell almost 5% on Tuesday, with US crude erasing all of its gains for the year, while the global benchmark Brent hit the lowest level since December 2023. Brent settled 4.9% lower at $73.75 per barrel. Bitcoin didn't escape the risk-off tone. The cryptocurrency slipped 2% to $58,070. And shares in Hong Kong and on the mainland extended Monday's slide. On the mainland, the CSI 300 tumbled to a 7-month low earlier this week. The Hang Seng was down 40 points or 0.2% at a near 2-week low of 17,651 after tumbling 1.7% on Monday. And the Hang Seng projected to open by about 150 points at 17,500. That's according to the futures markets. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Welcome our midweek guests. We have with us capital preservation specialist at Financial Shield, Enzio von Pfeil. Morning, Enzio.
Morning, Peter.
And also joining us is Simon Kavanagh, the partner at BDA Partners. Morning, Simon.
Morning, Peter.
Two readings of US manufacturing production showed signs of weakness in August. S&P Global survey showed a decline from July to August, while the Institute for Supply Management was under the level anticipated by economists. The ISM Manufacturing Index was at 47.2, below Dow Jones consensus forecasts of 47.9. The gauge measures the percentage of companies reporting expansion, so anything below 50% represents contraction, and factory activity contracted for a fifth month. Timothy Fiore of ISM said companies were showing an unwillingness to invest in capital and inventory due to current federal monetary policy and election uncertainty. The S&P Global's manufacturing PMI also revised slightly downwards to 47.9, continuing to point to the most marked deterioration in the health of the manufacturing sector so far this year. So, Enzio, let me kick off with you. Do you think investors have maybe been underestimating the recession risks? Everyone's been talking about a soft landing here, but we've got a stark reminder here, haven't we, that there is weakness in the economy?
Yeah, I think there's a, for me at least, there's a very clear change in economic time from the excess demand for goods, which of course had been driving the inflation, into an excess supply of them. That doesn't mean the end of the world. It just means that things are worsening. I'm wondering whether just psychologically it's that things are worsening, or that people have just been so delusional and so caught up in the drinks party of rising share prices that they needed to be pulled back down to the rug, down to the floor. That's my overall interpretation. It's a reality check, basically.
Simon, what do you think here? Investors, are they underestimating the recession risks here?
Well, I think on the manufacturing side and sort of the industrial output in the US, you've got both sort of the knock-on effect, obviously, of this long period of high interest rates, which has reduced investment and capital expenditure. And also, I mean, coming up to the elections, there's general uncertainty as to which way things might go. So people are naturally going to hold off on investment decisions, perhaps until sort of 2025. So I think it's really a function of that. But it's also, I mean, it is a sign of the weakness of the slowing of the US economy. I wouldn't say necessarily weakness, but the slowing of the US economy. But this is, of course, exactly what the Fed wants. And we're now reaching that pivot point where the economy has weakened to the stage where the Fed obviously decides it needs to cut rates before things get worse and there's a risk of falling into a recession.
You see the economy weakening, but you don't see a recession. Even, of course, there's always a risk, isn't there? But you don't see a recession coming.
No, I don't. It's still growing. It's got 3% growth. I don't think we'll have a recession. I think they'll manage the soft landing that they've been going for. But there's been a lot of stock market obviously has gone up hugely. And so now that there's any kind of sign of volatility, there'll be profit taking and uncertainty. And we see that ahead of Friday's jobs number, which is causing sort of a lot more anxiety than I think it typically would. Just people saying that they don't want to be on the wrong side of the jobs report in terms of whether it comes out too strong or too weak. And obviously, what's that going to mean in terms of what the Fed does in September?
It's going to be a key piece of data, isn't it, really, that could well tip the scales in terms of what the Fed does in just over a week's time.
Yes. And so, whether we get a quarter point cut or we get half a point will really, I think, depend on how Friday comes out. And certainly the weighting or the probability that the market is expecting of a half a basis point cut has increased just sort of in the last 24, 48 hours. My gut feeling is I think they'll go for a half a point cut. I think they can always sort of just dial it back, maybe skip a month later as we move into the end of the year in terms of cuts. But I think they'd like to come in strong with a signal that now we've turned the corner, and there's sort of some good sentiment behind it.
Can I just add to what Simon was saying? He was alluding to the pivot of the Fed, which means that it's going from fighting inflation to fighting unemployment in very simple talk. That's pretty realistic. It's also very interesting that the Fed has changed its whole policy way of doing things by going more holistic in the data analysis, as far as I know. In other words, not just taking one key data point and really hinging everything on that, but being a little bit more holistic, more all-embracing about which numbers are coming out. So I also think that a lot of that ebbing consumer enthusiasm is because, first of all, according to some article, I think it was in the Economist this week, a lot of the mortgages that have been very low, the rates have been very low, are now having to be rescheduled. I think there's just a certain sort of in the mortgage cycle, that's how these things are done. And also many people were getting government stimulus payments, and those are now, and they of course spent all that stuff. They spent all that stuff, and now these payments have run out. So there's just less cash in the kitty, basically. None of this is dire, no.
One of the comments in the ISM survey, yes. It said companies were showing an unwillingness to invest in capital and inventory due to current federal monetary policy and election uncertainty. Is that going to be the story, do you think, every month now until the election is out of the way and we've seen what the Fed is going to do?
I think there's a good bit of common sense in that. I mean, if the companies are producing less, it's got to mean inter alia that they're sitting on pretty high inventories already. I mean, why keep on producing gangbusters if you already have a lot of stuff in the back shack anyway? And yes, the election uncertainty is just going to keep people very much on their toes. Although I myself don't really think that the outcome of who wins is as crucial as all that. I think, having been on the Hill for many years, it's run out of kind of the backdrop, and these actors on the front stage are more kind of marionettes of what's really happening backstage. So I don't think there will be any tumultuous changes.
What do you think, Simon? Do you think we're going to see more of this, companies holding back on investment in capital and inventory because they want to see what happens in the election and they want to see what the Fed does?
Yeah, I think so. And I mean, there'll be the rhetoric on tariffs as well. If tariffs were to increase significantly and essentially you needed an increase in domestic onshore manufacturing in the US, that would have an impact. But obviously, there's quite a long lead time between starting to build a factory and actually producing the goods. I agree with Enzio as well that regardless of who actually wins the presidential election, the economic direction of the country is not going to change terribly much. The Fed will obviously do exactly what the Fed wants to do, and there'll be a lot of talk about jobs in particular coming up to the election, but there's not a huge amount that the president, particularly if there's a divided Congress, can do on a federal level.
I want to ask you both about some of the commentary that was in this ISM survey, because the numbers only seem to reveal half the survey, but the commentary itself was sounding pretty dire. Here's a couple of things they said. They said a further downward lurch in the PMI points to the manufacturing sector acting as an increased drag on the economy midway through the third quarter. Forward-looking indicators suggest this drag could intensify in the coming months. The survey then went on to say slower than expected sales are causing warehouses to fill with unsold stock, and a dearth of new orders has prompted factories to cut production for the first time since January. Producers are also reducing payroll numbers for the first time this year and buying fewer inputs amid concerns about excess capacity. And it goes on, there's more. It says the combination of falling orders and rising inventory sends the gloomiest forward indication of production trends seen for 1.5 years, and one of the most worrying signals witnessed since the global financial crisis. That sounds pretty dire, doesn't it? I mean, it's like more than recessionary talk there. It's almost depression talk.
Yeah, but I think that if I can just maybe kick off, I think that I'm not downplaying this, but we have to keep, I think, in mind that the manufacturing sector is not the be-all and end-all of the U.S. economy. Maybe Simon has a number at hand, I don't, but I don't even think it accounts for a third of all employment. Maybe one of you gentlemen knows, but so I wouldn't overrate just the downturn in manufacturing. Of course, a lot of that's gone offshore thanks to our multinationals in America. The other point that I think is very worthwhile making is that there's a lot of sort of dialing back on the excesses of the past couple of years. In economics, we call this the cobweb cycle, or perhaps less prosaically, the pig cycle, when people make a little bit of money, they see neighbor Joe's making money, so they go and invest like crazy and build up, and then it becomes a huge reinforcing cycle up, and then bang, something happens and too much supply around, and bang, down go the goods, down goes the production. So I think it's also a little bit of soul-searching remorse, just people being brought back down to earth that's going to reinforce. But again, I mean, whether these PMIs swing between this digit bashing has always bothered me as an economist. Unless we find some major crash somewhere, which I don't really think needs to happen, I think it's going to be a fairly steady-ish descent.
As Enzio says, in terms of digit bashing, what did it do? It came in at 47.2, which was better than last month, but it's below what the economists were expecting at 47.9, so therefore it's a disaster. But really, in the scheme of things, how much does that actually make a difference? And yes, manufacturing is a far smaller portion of the US economy than it is in China, for example. So I mean, when you read it, like they wrote it in the ISM report, yes, it does sound fairly dire, but I think all that'll do is perhaps push the Fed a little more towards the 0.5 point cut rather than the quarter. But I don't see it as a long-term issue for the US economy.
Well, I'm going to continue with the recessionary talk because the markets here now, the markets, the Fed Funds futures markets, they are pricing in more than 200 basis points of Fed rate cuts over the next 12 months. Now, that is a pace of easing that has never been seen before from the Fed outside of a recession. So something's wrong somewhere, isn't there? Either the markets are wrong, which wouldn't be the first time, or maybe once again we are underestimating the odds of a recession. What do you think about what the markets, what the message of the markets is here?
I think that the markets have been pretty damned wrong, to be honest with you. Last year they were forecasting rather assuredly, and that was the worst bit, 6 rate cuts, if I believe. this year they were prancing around with 4 rate cuts. It's a little bit all too good to be true, and a little bit razzle-dazzle economics. So yes, nobody can say there's not going to be a recession. But I think that this trying to sort of dramatize things is, having lived in America so long, is a very American thing. It's either got to be all glory or all death, and there's kind of no little way in the middle that you can maybe just kind of dampen down the emotions.
Simon, 200 basis points of rate cuts over the next 12 months. What do you make of that?
I mean, maybe. But I mean, historically, if you look back over the last couple of years, it's shot up from a very low base. So yeah, it'll come down. And even if it comes down by 200 basis points, what are we at? 2.25, 2.5. That's not, I think, historically abnormal. But I mean, really, it's anyone's guess as to the speed at which it comes down. I would be wary of kind of drawing conclusions with commentary like, oh, it's the fastest that it'll ever have been reduced. I mean, perhaps, but kind of so what?
I'm also a little bit leery, if I may just butt in, back to sort of your, and in a way, my bond trading days, Peter, that I'm not saying Fed funds don't matter, but I think they're so overrated. They don't have any impact on long-term borrowing. By the way, it's 33% of U.S. jobs are created in manufacturing. They don't. So yes, they affect the prime lending rate. We kind of guessed that, but having researched this just a little bit, the mortgage rates are way bigger. And so I think my eye is actually much more on those bond yields because of the rescheduling of the mortgages. And if those things go, if the bond yields were to go up, in other words, a massive sell-off on bonds, that's where the real scare factor is, much more for me than the cut in the Fed funds because they think that things are slowing down. It's just maybe just to add a little bit of a different twist on this.
What do you make of the stock sell-off today? Now, I should point out that there are some seasonal trends here. First of all, historically, the first trading day of the month is normally the worst day of the month. And secondly, September is historically the worst day of the year as well for US stocks. So we've seen a sell-off again at the beginning of this month, just like we did at the beginning of last month. Is this just more a continuation of the historic sort of trends, or is there a warning there somewhere?
I think it's a bit of profit taking. The market's still significantly up on the year. So, yes, there's a little bit of hesitation again around, the jobs report, not quite sure what the Fed's going to do, and people will be taking a view, well, with volatility rising, I'll just take some money off the table and wait and see for a little bit. And yes, the September being the worst month of the year kind of almost becomes a self-fulfilling prophecy. If everyone talks about it, then everyone reacts to it accordingly. So I don't see it as anything particularly significant or worrying. I mean, the amount in NVIDIA dropped in dollar terms is enormous, sort of $280 billion wiped off its market cap. But it's been such a star performer that in percentage terms, if you look back and you've held it for the last 12, 18 months, you're not going to complain.
It's really the madness of crowds that also comes into this from the sort of psychological angle that people don't initially, then they all hop on the bandwagon, and then the smart guys get out first, and then the dummies follow.
How much are the trade tensions between the West and China weighing on the market? It seems President Xi Jinping is going really all out now on this state-led manufacturing model, which the West says is dumping all sorts of products onto the market. China's added capacity to produce some 40 million electric vehicles a year, even though it sells only around 22 million at home. It's on track to make about 750 gigawatts of solar cells, despite only needing 220 gigawatts itself. It's going to account for 80% of the world's supply in basic chemicals such as ethylene and propylene. We know about steel. How much of this is a problem, and how much are we seeing China really doubling down on this model, and the West reacting to it with more and more tariffs.
Well, the problem, if I may start, is that because China can produce at vast economies of scale, because guess what, they've got quite a billion plus people. This will drive global deflation, and that's, I think, a bit concerning, because the incomes fall, and then people just globally spend less, because if you're buying it, and so the tariffs are, of course, the ready reckoner for the countries to not buy the stuff by like the Canadians recently have done, by just slapping on tariffs. And then, of course, the Chinese retaliate by not selling them this metal that I always forget. It starts with antimony or something like that.
Antimony.
Antimony, yeah, sorry. I always called it alimony, but I don't know when that's happening. So there's a danger there that really more for global deflation, and but the worse this global deterioration economic time gets, it might take stagflation in the US, deflation in China, the more feisty politicians will get in each country, because as Tip O'Neill, that old China hand, once said, all politics are domestic.
Mm. Simon, what do you make of this? Because it's getting worse, isn't it? As China ramps up its exports and dumps more and more products on other markets, we're getting companies all over the world calling for protection from their governments. We've got the chief executive of Mitsubishi. He's called for a more active strategy from the government to help Japanese counter increasing Chinese competition. The vice chairman of Nippon Steel has asked for tariffs on Chinese steel exports to Japan, because they say if we're the only ones that don't have them, all this product is going to get dumped on our doorstep. So what do you make of this, Simon?
Yeah, so it's an escalating problem, which is disappointing, because I'm a sort of believer in free trade, and quite frankly, if someone's able to produce something cheaper and of better quality, then you kind of should be buying it, and that can be their competitive advantage. I mean, China's obviously propping up its manufacturing economy hugely. The government is doing that just from an employment point of view and from a GDP point of view. But foreign governments are reacting kind of not necessarily unsurprisingly, but still somewhat disappointingly with tariffs. And the situation's getting worse. It's not just US and China now. Obviously, we've had Europe with the EVs, and now with Japan coming into it, which is unusual. So, yeah, the situation's not going to get any better. But, I mean, quite frankly, cheaper solar power in the rest of the world would actually be, I think, a better thing. You can argue whether EVs are sort of a better alternative for just the economy and the environment to combustion engine vehicles. But I mean, if you say they are, why are you sort of putting a stranglehold on your consumers by sort of limiting their access to them? So changing, unfortunately, anytime soon. And I mean, you've now got sort of odd situations where you have, say, the US telling Japan not to sell semiconductor and sort of components and technology to China, but at the same time telling Japan that they can't go and buy US steel. And sort of, if you're telling your friends that you can't even invest in the US, that's quite a sorry state of affairs, really.
Enzio, where does this cross the sort of the red line, if you like? Because, of course, countries throughout history have exported their spare capacity. If there wasn't any spare capacity, there wouldn't be any trade, would there? So, of course, that's what countries do. They export their spare capacity. But when does it start to become a problem? Is it because of the large scale that China is doing this on, or is it because it's being done with huge subsidies from the government that are going to these companies? What is it that's the problem?
I think it's back to my thing with all politics are domestic. I think once it starts hitting the employment in the other country, the country that's being stuffed with these cheap goods, it's interesting that Volkswagen, obviously Germany, already got a lot of flack this week, apparently, by saying to its workers that it would cut a lot of its production in Germany, I think like about a third or something, before its initial date of 2029. In other words, they want to do that very soon, again, because of, guess what, more competition from places like China. One also has to mention that China is not just exporting deflation, it's also creating deflation internally. There was a very interesting article in the Financial Times this week how the local companies in China are really beating each other up, a race to the bottom. And that, again, can't be good. And so, again, it's this long-term cobweb cycle that a few people, the first mover advantage, a few people produce the chips at a great profit, then everybody piles in, then the price wars begin, then everybody piles out, then off we start again. So there's also a big cycle, but I'm afraid that the feistiness on the political front and the job insecurity coupled with AI, which is not exactly job enhancing for most people, that's where the rub is.
That's a good point, because people often say, well, this is great for the US consumer. But if you're the same US consumer that's just lost your job because your company can't compete with these imports, then it's not so great anymore, is it?
Well, that's why I wrote a book on trade myths years ago, and it was because I was so annoyed with the Senate Foreign Relations Committee, frankly, that I really showed, I think, pretty empirically quite solidly, I'd like to think, that it's the U.S. multinationals who are creating America's deficit by producing abroad. So instead of Coca-Cola being produced in Georgia, it's being produced in China. Well, guess what? Then you don't need to export it from Georgia. So it's of course to service the Chinese market much more than to export the stuff back to the U.S. But there you have it. So that's the U.S. multinationals are very much at fault by going offshore, not retraining their local labor forces. I mean, TSMC couldn't even find enough laborers in Arizona to set up its chips factory there, as far as I know.
Simon, this is, of course, all combined with the fact that President Xi Jinping's not really doing anything to help the Chinese consumer. He just doesn't seem to like the sort of style of US consumption. He just doesn't want to see that in China. So presumably, Simon, that's sort of adding to the problem, isn't it?
Yeah, it is. I mean, the Chinese consumer suffers not from a lack of money, but from a lack of confidence in terms of spending that money. And Beijing is not doing anything, I think, to change that. It really should be a multi-pronged effort. I don't believe propping up the real estate companies is the solution. It's going to absorb an enormous amount of money, and it's not actually going to trickle down to consumer sentiment. So, yeah, we'll wait to see. I mean, one of the factors is, I mean, as U.S. interest rates come down, obviously the dollar is then going to come down a little bit, certainly vis-a-vis the renminbi. And then if China starts to appreciate, that's going to make its exports sort of less cost effective. And I mean, it's the cost advantage is what has kept the Chinese manufacturing sector afloat. And I mean, even for the US corporates that still manufacture goods in China, even though through all the talk of China plus one, China is still incredibly efficient and cost effective for manufacturing. A depreciating currency would help that and would stop some of the sort of removal of manufacturing base in China to other, sort of particularly Southeast Asian and to India. I don't think China's going to allow the currency to depreciate.
We seem to be going around, though, in a vicious circle, don't we? Because as Western companies react to all of this by imposing tariffs, China has now made it very clear it's going to react back, as we've seen with Canada. It's now started an anti-dumping investigation into canola imports from Canada after Canada imposed 100% tariffs on Chinese EVs, 25% tariffs on imported steel and aluminium. This is sort of becoming a race to the bottom, isn't it?
Yes, and I mean, I'm not really sure. I mean, Canada imposing tariffs on China EVs. It's not as if they're protecting a domestic electric vehicle manufacturer in Canada. So I think perhaps it's just because it's so linked to the US.
Yeah.
I mean, yes, if China is the largest importer of canola oil from Canada, fine, they can announce a inquiry and things, but ultimately, if they start putting tariffs on, they're going to be hurting whoever is buying this in China. But yes, I mean, this is the problem with governments, and you start down this road of tariffs and protectionism, is everyone feels the need to react to everybody else, and it just ratchets up.
And Enzio, final thoughts from you. I mean, the problem is none of this improves the competitiveness of domestic companies, do they, that are involved in imposing all these tariffs?
Quite. And I'm going to go one step further, having been professor for a while, that it's also, we're going to have a huge, and I think we're already seeing this rolling revolution in America. The middle class education, particularly in America, which I went through, is absolutely dreadful. It is not training the young people for tomorrow's jobs. It's interesting that a lot of young people don't even want to go to college anymore because I can't afford the student loans. What am I going to get? What's the bang for my buck? But I'm not hearing that magic word of vocational training where the Germans, the Swiss, the Austrians really lead. You still need your car repaired. You still need your haircut. You still need the piping in the house done. And everybody fluttering around with their BA degrees is too good to do these things. I think that, but that income is very steady. These people are hugely in demand. And I wish that the educated would start getting back to that very basic thing that we still need a lot of people to do some very menial tasks. And there's a lot of money in that.
Very interesting discussion. Sadly, we've run out of time, but we'll have to continue this another day. Thank you both very much. That's Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. Simon Kavanagh, who is partner at BDA Partners.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
I'm joined now by John Beirne, who is Principal Economist at the Asian Development Bank. Good morning, John.
Good morning, Peter. How are you?
I'm very well, thank you. A lot of talk, of course, about Fed rate cuts coming up. We've got the jobs data from the US on Friday, which maybe will determine whether we're going to get a 25 basis point or a 50 basis point interest rate cut in September. What would be the impact of that on Japan and on the Japanese yen?
Well, yes, as you said, we will be expecting monetary policy easing to commence in the US. It's a question of whether it's a 25 or 50 basis point cut. I think expectations are leaning towards a 25 cut, of course. It would take a major deterioration in the labor market to trigger something more than that. And in terms of what it means for the yen, obviously, this will lead to further compression in the US-Japan yield spread, which will support the yen. And, it's a question of whether this would take place in a gradual manner, looking further ahead. We saw that the recent period of volatility at the start of this month was really triggered by the combination of different factors, the surprise in the US, the largely unexpected hike by the Bank of Japan, which triggered this, very significant unwinding of yen carry trades. And, structurally, we can continue to see some narrowing in this spread going forward and continuing unwinding of yen carry trades. But again, as I said, if it would be taking place in a gradual manner, this would be, keeping a lid on the global volatility implications of that.
It seems we've got to get used to more volatility, doesn't it? Because that big sell-off that we saw at the beginning of August that you just mentioned, which was really a stock sell-off accompanied by a jump in the yen, we seem to have seen a repeat of that overnight. A big stock sell-off, well, globally really, but particularly in the US, and once again a jump in the yen. Have we got to get used to this type of volatility maybe as interest rates in Japan normalize and they come down in the US?
Well, I think, there's an increasing focus on data dependence by markets at the moment, and this is perhaps leading to some volatility, particularly when the data releases are beyond expectations. I think if we were to take the episode of the end of July, start of August, this was something that was could be regarded as a blip, or a number of different events occurred at the same time or very close to each other to trigger that level of volatility. We saw the VIX shooting up massively at that time. So I think we need to be on the lookout for data releases and can expect some volatility to materialize as a result of that. But there are other vulnerabilities, of course. We didn't mention the global tech stock sell-off at the start of this month as well, and there are continued valuation concerns in that particular sector, which is also going to be subject to volatility ahead.
We had last month the Deputy Governor of the Bank of Japan suggesting that the central bank wouldn't raise rates while markets were unstable, I think, as he called them. But yesterday, Governor Ueda sort of reiterated to a government panel that the central bank's going to continue to raise rates if the economy and prices perform as expected. So should we take from that further rate hikes are on the cards?
Well, I think it's difficult to read into it. I think the initial comments came out after, of course, the period of excess volatility in markets, and the rate hike by the Bank of Japan at the end of July triggered some appreciation in the yen, but of course, it was not expected that there would be a significant and substantial unwinding of carry trades. And the reason that happened, of course, is because we had the additional impact coming from the Fed side and talks of even a 50 basis point cut at that time. So I think the initial comments coming out of the Bank of Japan were to say that, we're not going to amplify the situation and, make the carry trade unwinding potential even worse than it is. On the other hand, if inflation continues to be problematic and justifying some hike in rates, then this will be carried out. But I think there is an eye on the exchange rate at the moment, clearly. When the Bank of Japan, for example, if we take the period in the middle of July, the yen was trading at over 160, and we're now at a level of 146 or something like that. So I think the yen exchange rate is something that the Bank of Japan is keeping an eye on, although it's obviously not targeting any particular level.
It seems, doesn't it, that the monetary tightening from the Bank of Japan and its impact on the flow of global capital is really not fully understood, and it's clearly far from simple as well. So is this going to have quite a large influence over maybe not just the next few months, even the next few years?
Well, as you know, the Bank of Japan has had zero or even negative interest rates for some time over the past couple of decades. So this has facilitated yen carry trades as being a very rational strategy for investors to take. Now this will gradually change to some degree over the next few years as the Bank of Japan would continue to normalize monetary policy. So some hiking can be expected in the future. At the same time, the US is expected to ease. So we will still get this narrowing in the yield spread, which will reduce the attractiveness of yen carry trades, but it would still be a viable strategy, of course, because a spread will still be there, albeit smaller. So I think we can see some adjustments taking place as regards financial flows in terms of yen carry trade positions as a result of what we will see taking place in monetary policy in Japan and the US. But the question is whether it will take place in a gradual manner, which can be mitigating these volatility effects on markets, or if it would be something more abrupt. And I think that what has been learned from the period at the start of this month in particular is that communication on where central banks are likely to go with monetary policy is key. And communication on this data dependence is also very important. So it's not really about data point dependence, but data should be communicated that it's being considered in terms of the overall monetary policy decisions.
And how much is the trade tensions between China and the world's other large economies impacting the markets here as well? We're seeing more and more, aren't we? China doubling down on its export model and dumping its excess capacity on markets all over the world. They're reacting with trade tariffs. China, in turn, is reacting back, as we saw with its investigation into canola exports from Canada. And those countries that haven't so far reacted with tariffs and now have got some senior executives calling for tariffs to be raised there as well, including in Japan. We have the vice chairman of Nippon Steel wanting to see tariffs on Chinese steel exports because he says if we're the only ones that don't have them, we're going to lose out. We had the chairman of Mitsubishi calling for help from the government to cope with this as well. How big an issue is this becoming?
Yeah, I think it's a growing concern. I think global trade tensions are escalating. But this is very clear. You gave the example of steel. I think a number of countries already have tariffs in place against China in this regard, and Japan, of course, at this moment does not. And there are calls to bring this into play in order to protect the domestic market. But of course, when these types of trade restrictions are brought into play, it can complicate matters even further for the domestic market should retaliation take place on the other side. So I think it's certainly an issue that's affecting investment, affecting trade, affecting the pricing of goods at the global level. And, of course, it's distortive, and I think there will be negative spillover effects to some countries as a result of that. That's clear.
And it sort of doesn't seem to end, does it? Because those countries like Canada, for example, it felt it had to put tariffs on electric vehicles and steel and aluminium because the US had done it, the EU had done it, and therefore it would be faced with its own problems. Japan has got a similar problem as well. But of course, none of this increases the competitiveness of domestic companies in either Japan or China, does it?
No, that's right. It actually is very problematic for the domestic market. And as I said, in particular, if there would be retaliation that would further worsen the domestic economy. In the case of Japan, for example, there could be retaliation in the form of exports of key minerals that would be needed for the production of automobiles, for example, in Japan. And this is something that can have wider spillover effects negatively across different sectors of the economy. So it's a real concern at the moment, I would say, yes.
And China's actually been warning of that already, hasn't it? That one of its possible retaliation steps is curbing exports of these rare earth minerals that are needed for smartphones, for electric vehicles, even for weapons production, all sorts of things.
Yes, I think, as you rightly say, there can be retaliation as a result of tariffs that are placed on China. And this essentially makes matters much worse. We have more fragmented markets at the global level and at the regional level as a result of that. And we have economies that are facing competitiveness pressures. And it's a particular issue in the case of Japan, I would say. The domestic economy is, somewhat fragile in terms of the outlook for growth. And I think, additional complications on the trade side, on trade fragmentation, on inhibiting the development of the local economy via the exports in key sectors is going to be detrimental to the overall growth outlook.
And finally, let me ask you for the latest update on Couche-Tard's interests in 7 & I, the owner of the 7-Eleven sort of chain. It seems that 7 & I is starting to talk about getting some sort of government protection from this, being given a special status on the basis that this chain of convenience stores is actually in the national interests, and particularly in times of disaster like earthquakes.
Yes, I've been following this story somewhat, and I think, as you know, corporate governance reform has been underway for some time in Japan, and the response by 7 & I to essentially upgrade its status in order to trigger some government protection from this type of takeover may call into question some of the efforts on corporate governance reform, particularly those related to shareholder value. And I think that we will just have to wait and see what the outcome of that is. But I think it's sending a signal that mergers and acquisitions are to be taken in Japan with some caution. I think, especially if we are seeing calls for government protection in the case of 7 & I.
This is a big test, isn't it, for the corporate governance reform in Japan? Because if there is truly going to be that, then in many ways this is good for promoting that. But at the same time, I get the feeling this isn't what the government meant when it called for corporate governance reform. It didn't envisage having a large foreign firm basically involved in the biggest foreign takeover of a key Japanese company.
Yes, it's certainly a big test for the reform in general, and as you said, I think the main focus was on improving shareholder value, addressing the cost of capital, the cost of equity, and these types of issues. But this is clearly a real test for the future of corporate governance reform in Japan, and how it is likely to basically succeed going ahead.
And it's sort of it puts into stark contrast the return on capital between Couche-Tard and 7 & I. I think the return on 7 & I over the past few years is about 1%. Minus 1%. Over the past decade, the total shareholder return for Couche-Tard is 191%. Big difference.
Yeah, big difference indeed. So I think we will have to monitor what happens in the next weeks. It's a story that is continuing to evolve quite rapidly, I would say. I think the 19th of September is given some date for some further information on that.
John, thank you very much indeed. Always a pleasure.
Thank you, Peter.
That's John Beirne, who is Principal Economist at the Asian Development Bank.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning and for supporting independent, fair and balanced broadcasting here in Hong Kong. Please help by subscribing to my daily Asian newsletter. It's completely free of charge, and that's where you'll find more information on some of the topics we've been talking about today. You'll find it at peterlewismoneytalk.substack.com. We'll do this all over again tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Economist Advisory, and Michelle Lam, Greater China Economist at Societe Generale Corporate and Investment Banking. And with a view from Taiwan is Ross Feingold, Director of Research at Cyrus Consulting in Taiwan. See you tomorrow.
Money Talk.